wanted to jump on here today and make some progress on a project I've been working on, going through Northwestern University's free online nonprofit course. And I will, at some point when I update online, okay, that works if I sit here. I will put the link for this video, which will be on M.A.K.E Alaska YouTube, and it'll be in much better quality than this video. So anyways, all right. Oh. Hi, baby. Oh, we probably have to update this. It's probably, oh, I didn't see that. My little kitty kitty, you gonna come over here and sit in my lap? Come over here and sit in my lap. My little love, my little kitty daughter. All right. Now let's see if this works. Start recording. All right, I think it's working. Okay, hello, it's Amanda with M.A.K.E Alaska and M.A.K.E Nevada. Continuing progress going through Northwestern University's free online nonprofit course. And in the description, I'll put the link if you'd like to do it yourself. So here we go. We are working on finance. All right, learn how the IRS 990 tax form can provide prospective board members with helpful information prior to joining a board, and how current board members should review the 990 before it is filled annually. I thought we already did this one. So let's see, we have finance. Maybe I'm wrong. Oh, nope. Aha, forgive me. Okay, here we go. Finance. Understand the difference between corporate accounting and nonprofit accounting. First and foremost, I would have an accountant. I'm not going to try to do this myself. Identify the key elements of nonprofit financial statements. Grasp the role board members can play in ensuring financial stability. Let's fix this so you can see my pretty stuff. Yeah, I wanted to make it cute for you. Give you a little cheer. We all need a little cheer right now, don't we? Yes, we do. All right. Exploring the differences between corporate and nonprofit finance statements. How many videos do they have? They have 1, 2, 3, 4, 5. Okay, 5. Probably won't get through all today. Learn how nonprofit financial statements differ from corporate financial statements in terminology, ownership, and restrictions. Review the 4 key types of financial statements for nonprofit organizations. View the video. And I have my coffee. It's not noon yet, 30 minutes to noon, and then no more coffee. Why is this not working? View video. There we go. Sometimes you just have to yell at the computer. Applied thinking. As you watch the video, consider the following. Search online for the financial statements of a nonprofit organization you are involved with or care about. Are you able to find all 4 key financial statements for the organization? What are you able to learn about their restricted assets? Let's put this on 1.5. Smooshy. Let's put 1.5. Here we go. And you come over here and sit in my lap. Don't knock that table. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1.5. 1. I'm working on a
Hello,
little
my name is
project.
Jim Croft, the Academic Director for Nonprofit Financial Management Programs here at Kellogg. We're going to be talking about financial statements and what nonprofit financial statements look like compared to corporate statements. This information is going to be valuable to all nonprofits, regardless of your size, because it's good to see the comparison, especially for our board members. Every nonprofit organization in the United States is governed by a board of directors, or sometimes called a board of trustees. Among other responsibilities, board members collectively give oversight to the financial direction of the organization. This means that they will need to use the nonprofit's financial statements. In another video, we will go into more detail about how to read and use nonprofit financial statements. But for now, we're going to explore the difference between for-profit and nonprofit statements. But first, let me note that there are some major differences between for-profit and nonprofit financial statements that you should be aware of. The first is terminology. There's a difference in the names used for various financial statements, although they look very similar. For example, the formal name for the nonprofit's balance sheet is the statement of financial position. I will point out some of these differences in terminology as we continue our comparison of these two types of organizations. Another point to remember is net assets. We call this owner's equity in the for-profit financial statements. Equity, however, denotes ownership. There's no ownership in a nonprofit organization.
Okay, so for those of you who struggle to remember the difference between gross and net profit or assets, or just gross and net, here's how I remember it. Okay, you're on a fishing boat in Bristol Bay, Alaska, and you scoop up a bunch of fish, and it's really gross. It's the whole big shebang, and there's all kinds of stuff. But you gotta use another net to get out the gross stuff. Net is what's left over. So gross is the big bunch, and net is the second. It's what's left.
It has a public service mission, is tax exempt, and its governance structure precludes self-interest and private financial gain. Another terminology issue is net income or profit. For-profit financial statements will show net income on the income statement. That's revenue less expenses. But the nonprofit will show a change in net assets, revenue minus expenses, on its statement of activities. Another point is restricted net assets. Often contributions or grants are given to a nonprofit with restrictions on how those funds are to be used. Some restrictions are for a purpose, while others may be for the passage of time. Some donors may even restrict their gift to be held in perpetuity. An important point here to remember is that donor-restricted net assets cannot be used for general operations. Now let's compare a set of for-profit financial statements to a set of non-profit financial statements. For-profit financial statements may be prepared for a sole proprietorship, a partnership, or a corporation. For this discussion, we'll use a set of corporate financial statements for the comparison. The first corporation financial statement that we will look at is the balance sheet. The balance sheet describes the organization's financial position at a given date by listing the types and amounts of its assets, liabilities, and stockholders' equity. Assets are anything owned by a company that holds inherent quantifiable value. Liabilities are obligations to be paid and creditor financing of assets. Owner equity typically refers to anything that belongs to the owner of the business after liabilities have been satisfied. The relationship between assets, liabilities, and equity can be seen in what is generally referred to as the accounting formula. Assets are equal to liabilities plus equity. Stockholder equity is broken down into basically four categories in most corporate statements: common shares, preferred shares, paid-in capital, and retained earnings. Retained earnings, the firm's cumulative net earnings or profit after accounting for dividends. We can compare the corporate balance sheet with the nonprofit's balance sheet, or its formal name, the statement of financial position. This statement contains assets, liabilities, but no stockholder equity, since nonprofits have no owners. Net assets replace equities on the nonprofit's balance sheet. Also note that the net assets are divided into two sections: net assets without donor restrictions and net assets with donor restrictions. Net assets without donor restrictions are not subject to donor-imposed restrictions. These assets are unrestricted and can be used for general operations. Net assets with donor restrictions are subject to donor-imposed restrictions and cannot be used for general operations of the organization. Next, let's look at the income statement. The income statement lists all revenues and expenses of an entity and the resulting profit or loss for the period reflected in the statement. An official income statement is generally presented once a year, although corporations often issue interim reports each quarter, and nearly all companies prepare monthly income statements for their internal purposes. The statement of activities is a nonprofit organization's version of an income statement. Like the for-profit organization's income statement, the statement of activities measures the organization's performance during the reporting period. Revenue and support are shown in major categories such as contributions, program-related income, or investment income. Expenses incurred in the operations of the program, management general, and fundraising are also included in the statement. Like the for-profit income statement, the statement of activities subtracts expenses from revenue to arrive at net income. However, In the case of a nonprofit organization, net income is referred to as the net change in net assets. Now we turn to the statement of functional expenses, which is best described as a matrix, since it reports expenses by major categories or functions: programming, services, management, general, and fundraising, and their natural expenses. Natural expenses would include salaries, benefits, supplies, occupancy. In the statement of functional expenses, every natural expense category will be listed on a separate row, and every functional expense category will have a separate column. Note, there is no financial statement equivalent in the for-profit sector. And finally, we look at the statement of cash flows. One financial statement that is the same in all respects for both the for-profit and nonprofit organization is the statement of cash flows. The statement provides information about the sources and uses of cash during the reporting period and provides relevant information that supports the income statement or the statement of activity in terms of the organization's liquidity, flexibility, ability to meet obligations, and the need for external financing. The statement reports sources and uses of cash from operating activities, investing activities, and financing activities. As we can see from this comparison of for-profit and nonprofit financial statements, there are some similarities between the two types of financial statements, and yet there are differences in terminology, ownership, and the restrictions that are placed on some of the nonprofit revenue.
That was fun. When I was on a board, every month we would look at all the finances. So I am by no means an expert, but the more you do it, the more you pick up on stuff. How to read nonprofit financial statements. Learn how to use nonprofit financial statements as diagnostic tools to assess the financial health of an organization. Are you broke? Are you in the red? Or are you in the black? Look at this sweet angel. I don't know if the camera catches this. Let's see what my framing is. Oh, you don't even see it. I have a cat in my lap. She's the best. You don't even see it right now. You're missing out. All right, applied thinking. As you watch the video, consider the following. Revisit the image at minute 7 of the video, which shows how nonprofit financial statements relate to each other. Look at financial statements for an organization you are involved with or care about and consider. What is the financial health of the organization like at this point in time in terms of what it owns, owes, and has left over for programming? Ugh. What can you learn about how the financial health of the organization has changed over time? So to toot my own horn, I think one of my favorite compliments that I got is after I left the nonprofit that I was with for like 12 years, I think. I got compassion fatigue, and I kind of went a little crazy, kind of had a little breakdown. So that's pretty common when you're working in a nonprofit, especially with animals. There's a cat down here. Is a board member of the next generation of board members texted me and said that after they had reviewed all of the financials from when I was vice president and operations manager, he could not believe how I was operating that place with so little money. It was a COVID era, so, and many people can relate that during the COVID era, you had to get really creative when you had limited resources and money and whatnot. Learned a lot, kept the place afloat. Here we go. I think this is more Jim Croft. I like this dude. I like how he talks. Mr. Croft. Is it still him?
Hello, my name is Jim Croft.
Hi,
I'm the
Jim.
Academic Director for Nonprofit Financial Management Programs here at the Kellogg School. We're going to talk about nonprofit financial statements. And the information shared in this video is applicable to all nonprofit organizations regardless of size. When the leaders or board members of a nonprofit want to assess the organization's financial health, they're going to look at the financial statements. In his book on managing nonprofit organizations, Thomas Wolfe
Oh no, Mr. Croft, you froze.
suggested
Oh, there you are.
that a health metaphor is appropriate here because the financial statements are used as a diagnostic tool in much the same way that medical reports are used. For example, the first thing a doctor checks are the patient's vital signs, which report such things as temperature, pulse, blood pressure, at a particular point in time. The second thing the doctor checks is the patient's medical history over the course of time. Now, neither report alone is adequate. Two patients with exactly the same vital signs
I know,
may have a
baby.
very different health status. Unless the doctor can assess progress over time, a vital signs chart is inadequate. Yet the medical history is not adequate by itself either. Now, the same is true of a statement of financial position and a statement of activities when assessing financial health of a nonprofit organization. In this video, we will review the primary financial statements used by nonprofits to see how each statement can be used in the diagnosis of the financial health of a nonprofit. Before we look at the financial statements, let me review two important principles of nonprofit financial statements. The first is net assets. We call this owner's equity in the for-profit sector. Equity, however, denotes ownership, and there's no ownership in a nonprofit organization since a nonprofit has a public service mission and its governance structure precludes self-interest and private financial gain. The second is restricted net assets. Often contributions or grants are given to a nonprofit with restrictions on how those funds can be used. Some restrictions are for a purpose, while others may be for the passage of time. Some donors may even restrict their gift to be held in perpetuity. Here's the important point, however. Restricted net assets cannot be used for general operations. To help us in our tour of nonprofit financial statements, I've created a diagram to show how all the nonprofit statements fit together so that we can get a complete view of the organization's financial health. The first piece of the diagram is the statement of financial position, which is also the accounting formula. Assets are equal to liabilities plus net assets. Assets are economic resources available to fulfill the mission. Liabilities are obligations to be paid and creditor financing of assets. And net assets are lifetime revenue minus lifetime expenses. Now we can see from this illustration that the statement of financial position looks like a balance sheet, except there's no equity. In its place are net assets. Also note that net assets are divided into two sections: net assets without donor restriction and net assets with donor restrictions. Net assets without donor restrictions are not subject to donor imposed restrictions, while net assets with donor
A common donor restriction that you would see in the animal nonprofit sector is a donor making a donation, but you are not allowed to use it for payroll. It has to be used for the animals.
restrictions are subject to some restrictions that are placed on the gifts by the donor. Let's add another piece to the diagram. This is the statement of activities. The statement of activities is the nonprofit's version of an income statement. Like the for-profit organization's income statement, the statement of activity measures the organization's performance during the reporting period. Revenue and support are shown in major categories such as contributions, program-related income, or investment income. Expenses incurred in the operations of its program, management in general, and fundraising are also included in the statement. Like the for-profit income statement, the statement of activity subtracts expenses from revenue to arrive at a net income. However, in the case of the nonprofit organization, net income is referred to as the change in net assets. Since the change in net assets will either increase or decrease the net assets that are shown on the statement of financial position when the books are closed at the end of the year, we can take the liberty of saying that the statement of activity is a subset of net assets. Also note that the statement of activities is designed to show revenue and expense by net asset classifications. That is, net assets without donor restrictions and net assets with donor restrictions. Now there's a point here that is important for us to consider in reading nonprofit financial statements. And this is actually one of those points that is often misunderstood. Net assets released from restrictions refer to certain net assets with donor restrictions that have been reclassified as unrestricted net assets because the original donor imposed restriction has been satisfied. Expenses are generally shown on the face of the statement of activities as program services, management in general, and fundraising. Since this presentation does not give the reader any information other than the total of those three functional expenses, the standard setters have now required that all nonprofit organizations prepare the statement of functional expenses. Now we add another piece to the diagram. This is the statement of functional expenses. The statement relates to the statement of activity because it's designed to give further information about the expenses that are shown on the statement of activities. This statement is best described as a matrix, since it reports expenses by major categories or functions, such as program services, management in general, fundraising, and by their natural expenses, or the type of expense, such as salaries, benefits, supplies, or occupancy. In the statement of functional expenses, every natural expense category will be listed as a separate row, and every functional expense category will have a separate column. It's interesting to note that the IRS Form 990, which all nonprofit organizations are required to file annually, also has a similar statement with the same name.
Hi.
It's the statement that charity rating agencies and some donors use.
I don't know if I missed you already, but hi, number 2 with fries. Yes, those other channels are mine as well, if anybody's curious. At Mojave Body, YouTube, at Mojave Body is for fitness, specifically Pilates. I do other fitness. And then at Desert Denali is where I started to post videos for my dancing career, and I have a lot of other stuff to post. I just haven't ever gotten around to it. So, yeah, I'm a retired dancer. Yeah. I would not recommend that career, ladies and gentlemen. Do not go into that career. Do not go into entertainment. No, don't do it.
To calculate a ratio of program expenses to total organizational expenses. Some people believe this is a measure of nonprofit efficiency. Now let's add the final piece to the diagram, the statement of cash flows. This statement provides information about the source and use of cash during the reporting period and provides relevant information that supports the statement of activity in terms of the organization's liquidity, flexibility, ability to meet obligations, and the need for external financing. The statement of cash flow reports sources and uses from operating activities, investing activities, and financing activities. Taken as a whole, the nonprofit financial statements will tell the reader a great deal about the organization. They show the vital signs of what the organization owns, what it owes, and what's left over for programming. But it also shows how the financial health of the organization has changed over time.
Time is it? 11:48. We have more time. I'm supposed to meet some friends out in Boulder City to go look at the dam and Lake Mead. It's something I like to do when tourists are in town. Understanding the operating budget. Understand why the nonprofit operating budget is important and how it supports decision making, drives sustainability, and helps to accomplish the mission of the organization. Oh, well, thank you very much. Thank you. I'll say this, I'm old, and a lot of my dancing career was back in the days before people had cell phones and were filming themselves constantly. So I'm jealous of these young bucks that can document their whole career, because I have a lot of stuff from an era where, I mean, I have some footage, but I need to go to one of those professionals that can take that footage off of old style camcorders, even VHS tapes, and put it on digital. Fun. Who wants to do that? I don't. As you watch the video, consider the following. If you are able to access operating budgets for a nonprofit organization you are involved with, look at the past several years. How do these budgets represent management's plan for the organization? What historical trends do you see? What external factors may impact the operating budget this year and going forward? So I would say on this one, an example could be that you can see that they're spending money on certain kinds of facility repairs or remodeling or additions, historical trends. For example, let's say you see there's a money pit, like a well that is busted, and they keep on pouring money into a busted well. That's a historical trend. What external factors may impact the operating budget this year? COVID, that was an example. That's for sure. War, recession, election years, those kinds of things definitely affect budgets. Alien invasion.
Hello, my name is Jim Croft. I'm the Academic Director for Nonprofit Management Programs here at the Kellogg School. Today we're going to focus on operating budgets. And as we talk about operating budgets, I just want to assure you that these principles are going to apply to all nonprofits, regardless of size. So let's ask a question. Why is the nonprofit operating budget important? Well, the answer to that question is simple. The operating budget's about decision making and being able to drive sustainability and about accomplishing mission. Perhaps we should define a budget. Spiro defines a budget in a way that I think is the best I've ever seen. He said a budget is a quantitative expression of management's plan, which presents the intentions and objectives at all levels of the organization and provides a vehicle for monitoring and controlling the implementation of those plans. It's generally accepted that there are three types of budgets used in nonprofit organizations today. The operating budget generally includes regular unrestricted revenue available to the organization, as well as net assets with donor restrictions where the donor restriction has been satisfied. The operating budget generally includes salaries and wages, employee benefits, direct and indirect program expenses, management and general expenses, as well as fundraising expenses. The planning period for an operating budget is 1 year, regardless of the start date. The capital budget contains the plan for sources and use of funds needed for renovation, new facilities, and large capital acquisition. Like the operating budget, the capital budget is a planning and control document. Unlike the operating budget, which covers a planning period of 1 year, the capital budget generally covers several years. The cash budget, also known as the cash flow projection, gives management critical information about the inflow and outflow of cash to ensure that there will be enough cash available to operate the institution within the context of its plans. In this discussion, we will focus on the operating budget. The operating budget should be prepared in the context of the organization's strategic plan. As we begin planning the operating budget for the new year, we should review historical trends. That's a good place to start. On a spreadsheet, enter several years of actual revenue and expense results. Use this document and other supporting information to see if you can identify trends that might influence the budget assumptions for the new budget year. Analyze the revenue components over time, staff compensation, program cost, as well as management and general expenses and fundraising costs. Don't forget to use the statement of functional expenses in this analysis. It's very helpful. Next, review the external factors that might impact the organization. What are the emerging trends, economic conditions, demographic changes, and competitors, especially when considering fundraising? With the strategic plan, the long-term financial plan, and the analysis of both internal and external factors, it's time to start the budget process. I found that the best place to start is with the revenue forecast. Now, some will say that you should start by making a wish list of all that you want to accomplish in the new budget year. But that could lead to some unrealistic expectations when it comes time to balance the budget. Managing expectations goes a long way to get buy-in from colleagues at all levels of the organization. When building the revenue budget, test the certainty and uncertainty of major sources of support in the new budget year. Also consider the level of restricted funding that will be available because some donor restrictions have been satisfied and can now be included in the operating budget. Next, we will create the overhead expense budget. Include the expenses to fund required management, technology, occupancy, and the organization's administrative infrastructure. Determine what existing contractual requirements need to be included in the budget. And don't forget depreciation, maintenance, and repairs. And consider fundraising expense, the expenses required to support existing operating and program needs, as well as new initiatives or expanded goals. Next will be the program service budget. Now we need to determine how much funding we can allocate to the nonprofit's program service budget. Determine the mission-driven strategies that will guide the allocation of the scarce resources for existing programs and emerging opportunities. And don't forget contractual obligations either. Now it's time to adjust and balance the budget. This is often an iterative process. We may have to revisit the revenue assumptions, the overhead cost assumptions, the program resource assumptions. Even if a little negotiation may still be possible at this time, it's time to actually balance the budget. There's a danger here, however, and that's going back and exaggerating revenue in order to avoid making hard decisions about budget cuts. Now that we have the budget balanced and it's been approved by the governing board, we're not finished. It's time to monitor the financial activity and compare it to the budget on a monthly basis. We do this with a budget variance report. We should also create a portfolio of action to be taken if revenue falls below projected levels. Identify clear trigger points that prompt decision makers to take the necessary action to minimize the risk of a deficit budget. So why is the operating budget important to a nonprofit? Because it's about management's plan for the organization. It's about decision making. And it's about being able to drive sustainability. And it's about accomplishing the mission.
Okay. You see me looking off to the side, it's because my sweet kitty cat is just sitting there staring at me with love in her eyes, and I have to keep on looking at her and giving her little eye kisses. Okay. Did we just already watch that? Yeah, we did. Cash budgeting and variability of cash flow. Understand why it is important for the board to pay attention to the cash budget and how it can help an organization react to cash flow problems in a timely manner. As you watch the video, consider the following. If you are able to access a cash budget for an organization you work with, review it after watching the video. If appropriate for your situation, talk with a member of the finance committee about the challenges and opportunities the organization has in the coming year that relate to the variability of cash flows. There we go.
Hello, my name is Jim Croft. I'm the Academic Director for Nonprofit Financial Management Programs here at Kellogg School of Management. Question for you. Why is it important for members of the nonprofit's governing board to pay attention to the variability of cash flows? Well, unless there's cash available to meet current obligations, the organization is effectively out of business. Even if the nonprofit has a sensibly prepared and balanced operating budget, it only tells us how things should be at the end of the fiscal year. But the nonprofit executive and board need to know if there will be enough cash available each month throughout the year to meet its operating needs. Now, there's a tool available to the nonprofit to help manage the variability of cash flow, and that is the cash budget. The cash budget shows the timing of cash inflows and outflows, usually on a monthly basis. Unlike the statement of cash flows shown in the financial statements, the cash budget is forward-looking. Some may call the cash budget a cash plan or a cash forecast, but regardless of what you call it, it's an important tool for cash management. Here are some key features of the cash budget. It shows the unsynchronized nature of cash inflow and cash outflows. It shows seasonality of cash flows. For example, cash from contributions is usually higher in the fourth quarter of the calendar year. It shows the degree of cash mismatch, cash surplus or shortfall. It shows the duration of these surpluses and shortfalls. It shows the amount of short-term investment or borrowing planning that will be needed to provide enough cash to operate the organization each month. How would a nonprofit create a cash budget? The nonprofit does not need a cash budget program. Start with a spreadsheet, like Excel. The operating budget is your starting point. A conversion from accrual to cash basis accounting may need to take place. Calendarize the full year receipts and disbursements by cash inflow and cash outflow expected in each month. Study cash flow historical and seasonal patterns. Anticipate changes in those historical patterns that need to be made in the next 12 months. Include restricted net assets. All cash coming in from new restricted gifts, even if the donor restriction will not be satisfied in the budget year, should be included. Donor restricted net assets that will be satisfied and released from restriction also must be included. The act of releasing donor restricted net assets, depending on the restriction, may result in a cash outflow. Next, include the capital budget. Cash flows from investing activities and cash flows from financing activities. Now we'll combine all sections of the cash flow budget to show a complete picture of cash inflow and cash outflow projected for the next 12 months. Now we can see from the combined spreadsheet the organization's net cash flow for each month and the cash balance at the end of each month. We also see that this organization will have a positive cash balance of $772,130 at the end of the fiscal year, as seen by the green star below the month of June. However, the cash budget shows several months prior to year end that will have a negative cash balance, as shown by the red stars on the lines below the monthly totals. Fortunately, the cash budget has provided the information needed to react to potential cash flow shortfalls in various months throughout the year. So what can the leader of the organization or the board member do? Well, here's a few suggestions. Those donors that you know well, you may request that they accelerate their pledge payment. Plan the use of cash reserves if available, but if you do, pay them back. Short-term borrowing and a line of credit may also be used, but again, be sure to account for the interest on the short-term borrowing and line of credit. Nonprofits will face the challenge of cash flow variability even if they have a sensibly prepared and balanced operating budget. This is why the cash budget is an important tool in the the organization's cash management program. The cash budget outlines cash inflows and cash outflows. It communicates the importance of cash management, and it gives us the needed information to react to potential cash flow problems in a timely manner.
I think we're going to have time to finish this whole segment. That's pretty fun. That's a nice little sense of completion. That's always fun. Oh, maybe not. The importance of diverse revenue streams. Gain exposure to why diverse revenue streams are essential for nonprofit organizations to continue to drive impact, innovate, and continue to serve their missions for years to come. Colloquially, I'm not sure if that's the right word. Uh-oh, just happened. Did I go somewhere? 6 videos, here we go. Don't put all your eggs into one basket. That's a way to think about it. All right, applied thinking. As you watch the video, consider the following. Think about the nonprofit organizations you are involved with. How is the diversity of revenue streams determined by the factors mentioned in this video? Mission, operational model, legal structure, capacity, organization size, target audience.
Hello, I'm Sharice Ledette, President and CEO of YWCA Evanston North Shore. YWCA is dedicated to eliminating racism, empowering women, and promoting peace, justice, freedom, and dignity for all. To successfully execute on our mission and serve our clients, prioritizing diverse revenue streams is essential for ensuring a sustainable financial future for the organization. So, why do different types of nonprofits have different revenue streams? The diversity of revenue streams for nonprofits depend on their mission, operational model, legal structure, and capacity. The size of the organization, target audience, and the specific needs they address also shape their funding sources. For instance, nonprofits serving immediate, tangible needs like healthcare or housing often rely on government funding and fees for service. In contrast, those focused on advocacy, education, or cultural programs may rely more on individual donations, corporate sponsorships, partnerships, and earned income through program fees or sales. Ultimately, the goal is to build a resilient and flexible financial structure that supports the organization's mission and long-term sustainability. There are several benefits of diversifying revenue streams. Increased financial stability. Having multiple income sources protect the organization from economic downturns, funding cuts, or unforeseen events like a global pandemic. Flexibility to innovate. Having diverse funding sources allows the organization to explore new initiatives without being bound by the restrictions of a single funding source. And long-term sustainability. It promotes ongoing investment in the growth and resilience of the organization. However, there are challenges. Complexity. Managing multiple revenue streams can increase administrative burdens, requiring more time, specialized expertise, and capacity. Risk of mission creep. Chasing too many funding sources can lead to a drift from the organization's core mission and values. And finally, resource strain. Expanding income sources can stretch staff too thin, leading to burnout or decreased effectiveness. Philanthropy continues to be a critical source of support, especially for nonprofits with a focus on social impact, education, and healthcare. Individual donors, foundations, and corporate philanthropists provide vital funding through grants, donations, and sponsorships. Philanthropic funds often fill gaps left by other sources, covering costs like capacity building, outreach, and innovation that government contracts typically do not support. These flexible funds allow nonprofits to maintain independence and focus on areas of greatest need. In response to the pandemic, many nonprofits, including ours, pivoted to virtual events and digital fundraising platforms. Since then, we've harnessed digital tools like social media, email marketing, and virtual meetings to engage with donors and tell our story. We've also seen a rise in unrestricted funding, giving nonprofits greater flexibility in resource allocation. Additionally, companies have enhanced their philanthropic efforts, increasing support through matching gifts, employee giving programs, and volunteer opportunities. Donors are now more invested in shaping the strategic direction of nonprofits, focusing on measurable outcomes and impact, leading to deeper partnerships and long term funding relationships. In an ever changing landscape, diversifying revenue streams and fostering strong philanthropic partnerships are not just financial strategies, they are essential to ensuring that we can continue to drive impact, innovate, and empower those we serve for years to come. By staying focused on sustainability and collaboration, we strengthen our ability to fulfill our mission and make a lasting difference in the community.
All right, how long is the last video? I have like 9 minutes. Let's see. How long do you think it is? The tax form every nonprofit that board member should know. Learn how the IRS 990 tax form can provide prospective board members with helpful information prior to joining the board, and how current board members should review the 990 before it's filed annually.
Hi, I'm Liz Howard, the Executive Director of Kellogg's Center for Nonprofit Management and clinical faculty member at Kellogg. Though nonprofit organizations are tax exempt and often provide tax deductions to their donors, if they are based in the United States, they are still required to file a U.S. tax form called the 990. The 990 provides a transparent overview of the organization's financial health, governance, and operational practices. It includes significant financial details as well as a listing of board members and key staff with their salaries. Board leadership is required to sign the 990 annually to agree that the information is accurate and truthful. As a prospective board member, the 990 can provide you with great insights on the financial position. And if you look at several years of 990s, you can spot trends in the financial success of the organization, or the lack thereof. It is useful to you to explore this information along with financial data the organization shares with you prior to joining the board to ensure that you understand where the money comes from and where it goes. Reviewing the 990 can help to ensure that your values and goals align with the organization's mission and impact. As a current board member, you should be reviewing the information on the 990 and asking any questions you may have. In an ideal world, the whole board would review the 990 before it is filed. In practice, however, it is often the Finance Committee or Executive Committee that does this review. The following video by Professor Emeritus Don Hyder shares highlights and insights about the 990 form and the value it provides to donors and other stakeholders. It is much more than a government form, and board members should pay close attention to what is shared through it. Enjoy hearing Professor Hyder's perspective.
I'm Don Hyder. I'm a faculty member at the Kellogg Graduate School of Management, Northwestern University, where I've taught for more than 40 years, much of that in the area of not-for-profit management. I'm going to talk about the IRS Form 990, Return of Tax-Exempt Organizations. I'm going to talk about what is a 990, who files a 990, when they file it, why do we have a 990, what information can be found in the 990, what critical information is disclosed in the 990, who uses the 990, and then some takeaways and general references that might be useful to you if you have your opportunity to review a 990. The 990 is required by federal tax law. It is required to be filed with the IRS by some, but not all, not-for-profit organizations that are exempt from income tax. About a third of those organizations exempted filed a 990. Many are excluded because they are church-related, religious organizations under our First Amendment. They're excluded from filing under this, but many of those also filed. Who files a 990? Not-for-profit organizations with receipts, revenues that are in excess of $100,000 or total assets greater than $250,000 file the 990. Not-for-profit charitable organizations with lesser receipts or assets file the shorter form, which is a 990-EZ. Why do we require a 990 to be filed? We've been filing the 990s going back to the early 1940s. They increasingly, over time, provide more information. They are designed to help the IRS and regulators, and increasingly that is state regulators, where not-for-profits are incorporated, to ensure that the organization is true to its charitable purposes for which it was given tax exemption in the first place, and that private persons are not using the organization to enrich themselves for private gain. What key information can you find in the 990s? Well, the 990s provides information on the mission of the organization, its governance, its programs, compensation of its highest employees, how it's financed, and whether it's a going concern and it's sustainable or not. Briefly, I'll give you some of the summary parts of it. Page 1 of the 990 or Part 1 is a summary of the entire document. That tells you the mission of the organization, for which the organization was created, because not-for-profit charitable organizations are mission-driven organizations. Their activities, there's a section on the revenues, a section on the expenditures, and then revenue less expenditures and what net assets they have at the end. It gives you a clear indication of the last 2 years of the organization's financial viability. It has Part 2 of it, which requires the signers to attest to the fact that the information that is provided on the 990 is accurate and reliable to the best of their knowledge. This is important because the 990 gives an organization a chance to tell the public about themselves and what it does. So it's probably the most important document you're going to be reading about a not-for-profit or any organization. Part 3 of the 990 tells you about the program and services accomplishments, what it does, who it impacts, what measurements it's using. Part 6 deals with the governance, who are the board of directors, what are the policies that govern the governance of the organization, and are they following best practices or not. Part 8 deals with revenue, types of revenue, and the dollars amount, and how that has changed over time. Part 9 deals with expenses. They're categorized by how much is spent on the program or services for which the organization is is created, how much is spent for administration or overhead, and then how much is spent for fundraising activities. You want to know what the expenses of the organization are and how they've changed over time. Part 10, critical one, the balance sheet, the asset classes of the not-for-profit. As we know, there are 3 asset classes. Those that are unrestricted can be used for any purpose. Those that are temporarily restricted, such as a grant, can be used for the period or the explicit purpose for which the grant was given. And then those that are totally restricted, such as an endowment. Accomplishments, increasingly this is important. What metrics or performance indicators do they use to talk about what they accomplished or what they have done with this organization? Balance sheet provides a statement of the finances of the organization. Is a key indicator of assets less liabilities plus the net worth of the organization. How much of a going concern is the organization? Let me turn next to who uses the 990s. There are a wide variety of users. I won't go through each of them, but first of all, the users are the board itself of the organization, certainly the regulators of the organization, the employees of the organization, there are the funders of the organization, individual donors, grant-giving corporations and foundations. There are the media themselves that want to know more about the organization. There are academics that do research on not-for-profits. There are professional associations. There are all kinds of comparisons that are made about not-for-profits, comparability. So there are multiple users that each of them have their own specific use. And finally, they're the watchdogs of the not-for-profit organizations that have grown in size and scope over the years. They follow these 990s. Let me give you a couple takeaways that you might want to take from this experience of thinking about not-for-profits and their 990s. First of all, the 990 is a snapshot in time. It gives 1 to 2 years of information. So it's not a tell-all of the organization. If you want to look at the organization, you should look at it in 3 to 5 years of its financials over time, just not a simple snapshot, which may be not tell you a lot about the organization or where it's going or its condition. Second, organizations differ by size, by age, by life cycles in terms of the period in which they've operated in the charitable sector, and by program types. So this adds the complexity of comparisons when you try to use 990s to compare one organization to the next. Financial disclosures can be incomplete. For example, fundraising costs are usually underestimated or not fully reported by a number of not-for-profit organizations. No one ratio or metric defines the financial condition of a not-for-profit. Okay? And so that's important when you look at these and use a combination of it. GuideStar, for example, uses a number of different ratios and trends and metrics when it does its in-depth analysis of 3 to 5 years of not-for-profit organizations. I suggest if you want to know more about the 990, you go to the IRS yourself, and you can find out what the requirements, conditions, and how that 990 has changed over time. GuideStar has the most complete database on not-for-profits over time, charitable organizations. It can give you 5-year trends, basic charts, graphs, and give you a financial dashboard to look at the not-for-profits. The 990s can be your most reliable friend and your most helpful friend in learning about the not-for-profit charitable sector.
We did it, Smooshy. My kitty's over there. Oh, Blinky Eyes, I love you, Blinky Eyes. We did it. Just double check, but I'm pretty sure we watched all of the videos for this portion of finance. We sure did. All right, well, thank you for watching. This is Make Alaska. We're learning about nonprofits. Have a great day. Bye. And you as well, Make Nevada. Bye.